A huge event is rumbling in the stock market. When the SpaceX IPO happens, trillions of dollars could chase one stock. And two household names are likely to be sold aggressively to fund it: Boeing and Lockheed Martin. Not because they're failing, but because they're in the way. This has long been one of the most anticipated IPOs in history, and signs now point to it finally happening, with reports of a potential 2026 IPO being acknowledged by Elon Musk. Speculative valuations range from enormous to historic, but the number matters less than the flow of money. But the real story is where all that money comes from. Every dollar that flows into SpaceX stock has to flow out of somewhere else. Wall Street calls this capital rotation, and it might be about to hit the aerospace sector like a tidal wave. There are three things that happen before a mega IPO like this. We're already seeing step one, which is the intense speculation and private market repricing. Step two is where stocks start falling as large funds begin to quietly reallocate. Step three is where retail finally notices. In this video, we're going to break down why two legacy aerospace giants are prime examples of what happens in step two. So what exactly is capital rotation? The idea is simple. Imagine a large pension fund or an ETF that's mandated to invest in the aerospace and defense sector. They have a fixed bucket of money for this part of the economy. When a new irresistible company like SpaceX goes public, the fund manager can't just create new money to buy shares. They have to sell something they already own to free up cash. They're taking money out of one pocket to put it in another, selling existing stocks to buy the new, shiny SpaceX stock. This is the part retail investors never see and usually realize too late. This is what funds do, regardless of fundamentals. It's a mechanical process. Fund managers think in terms of categories. When they need cash to buy an aerospace disruptor, the first place they'll look is within their existing aerospace holdings. They will compare the high-growth, forward-looking story of SpaceX with the slower, more traditional companies in their portfolio. They'll ask themselves, why do I own this slow-growing legacy stock when I could own a piece of the company that's building the future? This can force a massive repricing. Stocks seen as old or stagnant face immense selling pressure, not because their businesses are suddenly failing, but because they are no longer the most attractive house on the block. The rise of private space companies has already transformed the space economy from a government-led domain to a dynamic commercial sector. And this IPO would be the financial world's stamp of approval on that shift. The first and most obvious candidate for this capital rotation is Boeing. For decades, Boeing was the undisputed king of the skies, but recent years have been incredibly turbulent, plagued by production issues, quality control scandals, and costly program delays. From a fund manager's perspective, the contrast between Boeing and SpaceX is brutal. Boeing has been struggling, posting years of net losses and carrying a heavy debt load. While the company hopes for a return to positive free cash flow in 2026, with analysts forecasting a turnaround from a projected $2 billion cash burn in 2025 to positive cash flow, it's a slow recovery that hinges on fixing deep operational problems. Then you have program-specific headaches. The 777X program, for example, is years behind schedule, with certification now pushed out, and it isn't expected to significantly contribute to free cash flow until closer to 2030. These issues make the company look like it's stuck in the past, while SpaceX is sprinting toward the future. Now compare that to the SpaceX story. SpaceX isn't just a rocket builder, it's a vertically integrated powerhouse. It launches with record-breaking frequency, operates the world's largest satellite constellation in Starlink, and is even exploring orbital data centers. Starlink alone has seen explosive growth, reaching over 8 million subscribers by late 2025. This provides a recurring revenue base that traditional manufacturers can only dream of. According to some reports, Starlink's revenue is projected to hit nearly $16 billion by 2026. Most importantly, Elon Musk has stressed that the company is already cash flow positive. And here's the uncomfortable truth. Even if Boeing executes perfectly from here, it still may not matter. When a portfolio manager has to choose, the decision becomes painfully clear. On one hand, you have Boeing, a company with high debt and a turnaround story that's still years away. On the other, you have SpaceX, a cash flow positive, hyper-growth company being valued more like a tech platform than a traditional industrial manufacturer. Selling a portion of a Boeing position is one of the easiest and most justifiable decisions a fund manager can make. Not because Boeing is broken, but because portfolios are finite. And here's the mistake most investors make. Boeing isn't the most vulnerable stock in this rotation. The next one is far more dangerous because it looks safe. The second major stock at risk is Lockheed Martin, but for a very different reason. Unlike Boeing, Lockheed Martin is a well-run, stable, and profitable defense contractor. It's the definition of a blue chip stock that reliably pays a dividend. And that is precisely its problem in this scenario. Lockheed Martin is the old guard. Its business depends almost entirely on government defense budgets. While this provides stability, it also caps its growth potential. The global space economy is projected to grow significantly in the coming decade, but Lockheed's business model gives it limited exposure to this exponential commercial growth. Let's look at the financials. Lockheed Martin has a massive order backlog, which recently hit a record of $179 billion. This provides fantastic revenue visibility, and the company consistently rewards shareholders. However, its growth is slow and predictable. Analyst projections for its revenue and free cash flow growth are in the low single digits. This is respectable, but it's not exciting. In the world of institutional investing, this makes Lockheed a value or dividend stock. It's safe, but it's boring. And boring gets sold to buy transformational. Once again, the narrative is a stark contrast with SpaceX. SpaceX represents everything Lockheed is not: explosive commercial growth, planetary scale technological disruption, and a business model that scales exponentially. While Lockheed fights for single-digit percentage increases in the annual defense budget, SpaceX is creating entirely new markets. A fund manager holding Lockheed Martin sees a reliable, low-growth asset. When the opportunity to buy into a company like SpaceX arises, trimming that stable but unexciting Lockheed position becomes a logical source of funds. It's a classic portfolio rebalancing move. Sell the low-growth asset to finance a position in a hyper-growth one. The financial results are solid, but in the face of a historic IPO, uninspiring can be a dangerous label. This capital rotation is one of the biggest stories developing in the market, but it's still flying under the radar. In the next video, I'm breaking down where this capital actually goes next and why most investors never see it coming. If you want to stay ahead of major market shifts like this, make sure to subscribe and hit that notification bell. And I want to know what you think. Which stock do you believe is most at risk from the SpaceX IPO? Let me know in the comments below. The SpaceX IPO isn't just about a new stock hitting the market. It's a validation event for the entire private space industry. It would re-benchmark what a space company can be worth and force a re-evaluation of every other stock in the sector. The immense demand for SpaceX shares would act like a gravitational pull on capital, and those dollars have to come from somewhere. For large funds, the most logical sources are the largest, most liquid, and critically, least exciting holdings they have. This is step 2 of the mega-IPO process in action. That puts a giant target on the backs of Boeing and Lockheed Martin. For Boeing, it's a story of being seen as a troubled giant, weighed down by debt and operational stumbles. For Lockheed Martin, it's a story of being the slow and steady incumbent in a world suddenly obsessed with speed and disruption. This brings us to step 3, the moment retail investors finally notice the shift. But make no mistake, this forced selling from large institutions isn't a sign that these are necessarily bad companies. For individual investors, it could create a significant buying opportunity. As fund managers rotate out, the share prices of Boeing and Lockheed could become temporarily depressed, offering a chance to buy into solid companies at a more attractive price. The rise of SpaceX isn't just about going to Mars. It's about to create a major gravitational shift right here in the stock market, and the aftershocks could be felt for years to come.